fundsupermart.com.
Hello everyone. Why is the global property sector an attractive investment? And what are the drivers for the sector in the next 3 to 5 years? Today we have Patrick, the head of Property Equities at Henderson, to share his view. Hello Patrick. What is your outlook for the global property sector for the rest of the year?
Here we are just after a G8 summit when people are trying to save Greece from coming out of the euro. I think it would be very dangerous if Greece did come out of the euro, because then who's next? Is it all in the price yet? I'm not sure. But clearly people have been selling euro-denominated assets. And this has had an impact on our sector in May, certainly. We were back where we were at the end of July last year, before the market dropped significantly. It had recovered almost all that ground, but now it's moving backwards again. That Eurozone issue is certainly very real. In the States, we have, whatever you want to call it, a fiscal cliff or a deficit ceiling negotiation that's going to run from July through to the end of the year, with the added uncertainty of an election. And it may be that growth will slow down, but it was running at a reasonably healthy sort of 2–2.5%, an improving jobs market. If that went into reverse, then we'd have some concerns. But I think the improvement in the US seems to be sort of quite well founded, at least for the time being. I think more importantly, if the global equities market, the global investment market remains cautious, then that will tend to favor the US and the US dollar as people look for a safe haven. If there is a recovery, then we would expect Asian stocks to bounce and outperform, but we think that that recovery is not likely in a sustained way for a year or so.
Given a 3 to 5 years horizon, what are the main growth drivers for the property sector?
Next 3 to 5 years is hard to call. The political uncertainties that we're facing mean that the outlook for markets generally are uncertain. However, our best guess is that we're going to see relatively modest growth on average across the global property sector. But in the meantime, we've got some reasonably decent dividends. There is no global property sector in the singular. We have to look at the different markets by region, by country, by different property type. Right now, we feel more optimistic about the US, partly because we see some growth in the underlying US economy. It may be slowing, we're not quite sure yet. But we also see some income growth in the REITs and even stronger dividend growth as they increase payouts that should actually make this sector quite attractive. We're not talking about developers in the US. It's not like Asia. We're talking about REITs who are almost pure investment companies with good quality properties, good quality tenants, and secure income streams. They also have a cost of capital advantage. They are able to issue equity, and they're able to raise new debt to refinance the maturing debt. And we've seen this demonstrated really across the board. Some REITs are more highly leveraged and others are finding it more difficult. But on average, they're in a good place as far as raising money from equity and debt markets are concerned. There are actually a number of sectors where we see quite strong growth. One of them is the hotel sector, which is recovering very nicely, having reached the level of occupancy above which most of the, or if not all of the income falls straight to the bottom line. The apartment sector, people are a bit surprised about this because they think the housing market in the US is depressed. Well, while people are not buying houses, they're renting, which is good for the apartment REITs. So they're seeing quite strong income growth. Some moderate but steady growth in the shopping center sector, and I'm talking mainly about the A and B malls. So the bigger, more dominant shopping centers are showing something like 4.5–5% rental or value growth, or sales growth, I would say, but that's feeding through into increased rents. And other than that, it's a bit patchy. Not much in the offices. Some metropolitan downtown office locations are okay. Not much suburban office activity. And industrial, again, one has to be very selective. Healthcare is kind of index linked, very steady. You can imagine there's quite a lot of demand for healthcare type properties, both what they call senior housing, but also hospital and medical facilities.
Compared to investing in traditional equity markets, why is the global property sector an attractive option?
Well, property equities, or property generally, has both the characteristics of bonds and equities. It has the same security as corporate bonds, i.e. the tenants are the same companies taken as a whole who issue corporate bonds. The leases tend to be for relatively long durations, 5, 10, 15 years, and therefore there is quite a long-term obligation. And it's those bond-type characteristics that we are valuing right now. But in the long run, you would expect growth from property values and rents in line with the broader economy, and this is more characteristic of equities. The other aspect of property equities at the moment is that they've been through the financial crisis and refinanced, repaired their balance sheets. And we don't see too much stress in that regard, not in the US, in very few European, at least, shall I say, Northern European countries, and very little financial or leverage stress in Asia, with the possible exception of Australia. And secondly, and perhaps just as important, is the lack of oversupply. This is not like the early 90s when we were facing many years of oversupply that needed to be absorbed before the market could move forward again. This time it's not about supply, it's about a lack of demand. That can change very quickly. And that is actually a significant issue, a significant advantage for those companies who are operating in markets where they can push rents forward. I'm talking, for instance, about the apartments market in the US. They can push rents up quite substantially because there is very, very little new supply. Here in Hong Kong, very little new supply, and rents being flat or maybe even falling a little bit is because it's a lack of demand, which again can change quite quickly.
Now, many countries in Asia, especially China, are rolling out property cooling measures. So what are the implications for property stocks investments?
Well, I want to leave China on one side because it's not an important part of our universe. Our universe is essentially the developed markets, and at least according to FTSE, who run the index that we look at, China is in the developed category. There are a couple of companies that do develop in China, but they're a tiny part of the overall global index. We are more concerned with what's going on in Hong Kong because of the residential exposure of some big companies here, and in Singapore. And we're not quite sure what's happening in the residential market here, and it varies according to which sector of the residential market we're talking about. Prices did ease a little bit, did fall a little bit, but they had a bit of a bounce in February and March, and we're not quite sure where they're heading. Clearly there is an undersupply of houses, and this will sort of keep demand up, but the fiscal measures that have been introduced, first of all, took some of the speculative demand out of the very high-end market. There hasn't been the shortage of mortgage finance or the increase in interest rates that some people were expecting that would have curbed demand. So we see a weak market, and against that background, we don't expect the share prices of the developers to give us much profit. Singapore, I think, is in a slightly different position. They have the same efforts to control residential prices, but they don't seem to be having any effect because demand has remained pretty strong and prices have continued at their previous levels and maybe even risen a little bit. That's to do with employment growth in Singapore.
Finally, given your views on the markets, how do you position to benefit the investors?
Our positioning is a small overweight, perhaps a slightly growing overweight to North America, with an underweight mainly to Asia, but we're not going to take very extreme positions in that regard because, one, things can change very quickly, and two, there are currency effects that very often confuse the issue. At the moment, we think that the Australian dollar will probably weaken. The Japanese yen seems to be defying gravity and staying quite strong. I think it's the only currency that hasn't depreciated against the US dollar so far this month, which I think is significant, perhaps to do with repatriation of Japanese yen by domestic investors. And I think the other currencies will tend to stick pretty close to the US dollar, certainly the Hong Kong dollar for obvious reasons, and the Singapore dollar too. It can't really get too much stronger. As far as Europe is concerned, we're certainly focused on London, which is the strongest market fundamentally. But I think also the pound sterling will benefit relative to the euro. There is an interesting group of European shopping center owners who are not growing, but they're not falling, and have a good dividend yield of over 6% in the meantime. So that's a low risk, a relatively high dividend, if low growth sector. And then there are a few companies in Scandinavia that are seeing good markets and are doing quite well. But we're out of Southern Europe, more or less. Very little exposure to Eastern Europe, so we're being very selective. And as far as Asia is concerned, we're pretty neutral at a country level, and focusing on the higher quality, larger companies, very often with good dividend yields.